Subsiding worries about inflation driving the Dow and S&P 500 to record highs Thursday, with the Nasdaq the top gainer on the day so far. Let's talk about rates, outlook for inflation with Art Hogan. He's Chief Market Strategist at National Securities. Welcome back. Good afternoon to you, Art.
Thanks so much for having me.
Great having you with us as always. Now, Art, inflation, as you see it, is less of a bogeyman. So why aren't you worried that this economy may possibly overheat? We just had this AMC as well as Bumble say that, hey, there's a lot of pent-up demand, whether it's for dating or the movies.
Yeah, you know what? It's not that we're concerned that there's not going to be inflation. We know there's going to be inflation. I think the concern that inflation is going to be something that's permanent is probably the wrong way to look at this. So there will be dislocations between demand for things the pent-up demand for things that we haven't been able to do for a year and how quickly we can get the supply for those things out. So in one instance, semiconductors right now, there's a great demand for semiconductors and there's not enough supply. Energy product, there's demand for oil and gas and there's not enough supply. Typically, when that happens, you see a supply response. So in the interim, we're going to have some transitory inflation for sure. And I think the core CPI could get as high as 3% before the end of the year. Call it in the middle of the summer, but I think we end the year back down to a much more normal level of about 2% CPI. And the important part about all of this is the Fed is going to look at that as transitory. They're going to say it's okay to let that run hot for a period of time. We don't think this is permanent inflation. Inflation expectations are very anchored at a lower level, and we suspect that by the end of the year, we'll stop talking about inflation and just talk about the amazing economic growth that we saw and how that drove earnings.
So transitory is the way you see it. Then how does that translate over into yields? Right now, today, yields are rather subdued, but that's been a big concern.
It certainly has. And yields were really a concern because of the pace at which they got to their next level, right? We entered the year below 1%, and we gradually worked our way up to 1.1%. And then over the course of 2 weeks, we went up 30 basis points, and all of a sudden we broke out of 1.5%. We touched 1.6%. And when that happens, it's disorderly, and that causes a lot of concern in markets. Because as human beings, we naturally assume when something's moving in a linear fashion, it's going to continue for a period of time. So I think the assumption in the bond market and the equity markets as well was, if we're going this fast, we could be at 2% on the yield in the 10-year before springtime. And obviously, we saw what happens. Those markets don't move in that fashion for very long. So we got to 1.5 really quickly. That's what caused disorder. And now we're kind of hanging out in the sort of 1.5, 1.55 range. And I suspect that will be the case for the next couple of months. I think we had a relatively successful Treasury auctions this week, as compared to 2 weeks ago when we had a 7-year auction that went very poorly. So we had 3s, 10s, and 30s this week. And the auctions went well. There's no disturbance in the Treasury market. So I think for the time being, that crazy move in Treasuries is not going to affect equity markets, at least in the near term.
So you don't see it derailing a bull market for now?
I don't. And I think that if we get to 1.75 or 2% by the end of the year, that'll be normal. I mean, that's the place we should probably be at if the economy is actually going to work at a pace that we think it will. So it's going to, if it happens the way Treasuries usually work and it's not parabolic, I think equity markets will be fine with that.
And Art, given all the volatility, have you adjusted your asset allocations at all, or your allocations within, say, the equities portfolio?
Well, what we've done is we've on a barbell approach to our equity asset allocation. We still have growth, and growth is really focused on 3 themes. They're all disruptive. It's 5G, very disruptive. Cloud computing, very disruptive, and cloud security. And we continue to think those are themes that have very long runways in front of them. On the other side, we want a balance of cyclicality, economically sensitive cyclicals. We like financials, industrials, and materials. And then what we do is every 2 months, we balance that out. So if the cyclicals are outperforming like they were in February, at the end of February, we trim those positions and add more to our growth. So February was the first time since we've had this balanced portfolio that we actually had to adjust that way. Typically, it's been the growth outperforming cyclicality, and we've had to trim that. So it's interesting that 2021 has been the year where cyclicality is actually getting overweight, and we've needed to trim that back. And I think that'll continue. But I think if you have that balanced diversification, then you're not trying to invest on either black or white every day. You're not saying, hey, I want to be cyclical or I want to be growth. You're diversified. And I think if you use this last year, you outperform the S&P 500 by 475 basis points.
And are in doing so, in rebalancing the way you have, are you putting in the profits that you're taking from cyclicals into what within technology, the 5G or the clouds as you were talking about earlier?
That's exactly correct. So what we'll do is, if the dollar weights stay average, the barbell stays level, right? So, and we do that every 2 months. So you're not day trading this portfolio. Every 2 months you're doing a rebalance, and you look at that and say, okay, am I overweight cyclicality? Do I need to balance that off and have some more growth? And interestingly enough, there are some 2 month periods where you stay in balance and don't have to do anything in your rotation. And February was one of those months where we actually had to trim some of our cyclicality and put it back into growth. And that's the first time we've done that in a while.
All right, so Art Hogan's barbell's rather even then now. All right, thanks a lot, Art. Appreciate it.
Thank you.
Our thanks to Art Hogan of National Securities. I'm Fred Katayama in New York. This is Reuters.